Welcome to the deep dive. We're here to sift through the noise, take a big pile of research, articles, notes, and really pull out the key insights for you. And today, we're diving headfirst into a really interesting story, one that's been causing a bit of drama on Wall Street. We're talking about a company that for ages looked unstoppable, a real stalwart, but then recently hit some, well, dramatic volatility. That company is Fiserv. Ticker is FAPIRE. And just so we're clear, this isn't the pharma company, Fiserv. No, this is the payments giant. For 2 decades, Fiserv has just been this absolute juggernaut, a consistent outperformer, right? Delivered over 1,600% returns for shareholders, just crushed the S&P 500 over that time. It's exactly the kind of business analysts love to call a compounder. Reliably growing earnings, growing value year in, year out. But lately, that whole narrative has taken a pretty sharp turn. After their first quarter earnings report, the stock just plummeted. We're talking nearly 15, maybe 17%. And if you look year to date, it's been down as much as 30 to 35%, even almost 50% off its all-time highs from back in April. It's a huge drop. So the big question on everyone's mind, and definitely ours today, is this. Is this a classic compounder on sale? A fantastic chance to buy for the long term? Or is there something, I don't know, deeper going on? Something more fundamental causing this really significant, sustained volatility? Our mission today is to take a really comprehensive deep dive into Fiserv. We're going to try and unravel the complexities of this company. It's crucial, operates behind the scenes mostly, but it powers this vast world of payments and financial services. We'll systematically unpack why the stock's been on such a roller coaster. We'll dissect the latest financials, see what they really tell us about its health, and maybe most importantly, explore what the future might hold for this payments powerhouse. Because the landscape is, well, it's changing fast.
That's absolutely right. And understanding Fahaz, it's not just about glancing at one earnings report. It's complex. It sits right at this critical intersection. On one hand, you have this foundational financial infrastructure, the very systems that make money move. And on the other, you've got the relentless pace of tech disruption changing everything. So to really get a handle on its market position, which is strong, its financial health, which has nuances, and these powerful competitive forces shaping its future, we really need to look beyond those simple headlines. It demands a detailed look, segment by segment. That's the only way to understand the whole picture, the opportunities, and the potential pitfalls too.
All right, let's unpack this then. When we say payments giant, what exactly is Fiserv? Because, many people might not recognize the name, not like Visa or MasterCard, right? But they are absolutely essential. They're how money flows in our modern economy. They're a global provider of financial technology, financial services. Basically, they're the essential middleman.
Yeah.
They connect banks, other financial institutions, businesses, big and small, with us, the consumers. They make sure money moves efficiently, securely, and increasingly in real time. It's a huge, intricate ecosystem they manage.
Yeah, a good way to think about it is like they're the digital pipes, the core infrastructure, and also the sophisticated operating systems that run underneath your everyday financial transactions. So when you swipe your debit card or, pay a bill online, use Zelle or something, or even just see your direct deposit hit your bank account. Fiserv is often working somewhere in the background, making that happen smoothly. They provide really crucial support to banks, things like core account processing, literally managing your deposit and loan accounts day to day. They help credit unions manage member accounts, and they give businesses from, the corner bakery to a giant retailer the tools they need to accept payments. Their operations are incredibly diverse. They span several critical areas. First, there's payment facilitation. That covers everything: card processing, mobile payments, real-time payments, the whole gamut. Second, digital banking tech. That's what lets your bank offer seamless online and mobile services. Then for businesses, merchant solutions. Tools for payment acceptance, sure, but also broader business management stuff. Core processing is still foundational. That's the bedrock tech for financial institutions, managing customer accounts. And finally, e-commerce. They handle online payment processing, fraud prevention, things like that. It's a really broad portfolio.
So thinking about their business model then, this sounds incredibly wide. A super diverse client base, that feels like a major strength. They're serving tiny businesses, huge multinationals, local credit unions, the biggest global banks, even FinTechs and government entities. That diversification, it seems like it would naturally provide some revenue stability, right? A buffer if one sector struggles.
Indeed, that client diversification is absolutely key. It's a core part of their strength. They can scale solutions for the biggest financial institutions. Think complex core banking modernizations, multi-year projects, generating really sticky long-term revenue. But then at the other end, for small merchants, they offer these all-in-one systems, things like Clover. These systems handle everything: payments, inventory, scheduling. They become almost indispensable partners. And that creates a very sticky relationship. It's hard for clients to switch away once they're integrated. This recurring revenue model, mostly from processing fees and ongoing services, it's huge, made up 81% of their 2024 revenue. It's not just reliable income, it gives them a high degree of predictability, which, the market usually loves in financial services.
Right, predictability is key. And just quickly on geography, looks like about 85% of that revenue comes from the US, with about 15% international. So still a very strong domestic base, but maybe some room to grow overseas too.
Exactly. Strong here, but definitely potential abroad.
Okay, let's dig into how Fiserv actually structures itself. This should give us a clearer view of where the money's really made. They basically operate through two main segments, roughly equal in size: merchant solutions and financial solutions. Let's start with merchant solutions. What's that all about? What's driving the growth there?
Okay, merchant solutions. This is all about empowering businesses, merchants, to accept card payments securely. That means in-store, swipe or tap, but also complex online e-commerce stuff. But it's more than just payments. This segment gives businesses tools to run more effectively, manage operations, connect with customers. And the key product here, their absolute flagship, is Clover. Clover is Fiserv's cloud-based point-of-sale, or POS, system. It also doubles as a business management platform. It's mainly targeted at small and mid-sized businesses, the SMBs, and it's way more than just a payment terminal. It's like a whole ecosystem for these merchants.
Okay, and this is where it gets really interesting, right? Clover seems critical. It makes money not just from payment volume, which must be huge, but also selling the hardware itself, the sleek terminals, plus software as a service fees, those recurring subscriptions for its apps, and a growing list of value-added services, VAS. So it's basically an operating system for merchants, managing inventory, employee scheduling, customer loyalty, analytics, everything. And the growth numbers you mentioned are just, whoa, impressive. Clover revenue grew 30% in Q2 2025. That's massive, and they're on track for their goal. $3.5 billion in Clover revenue for 2025, which is a huge jump from $1.3 billion back in 2021. That's not just growth. That's like explosive growth in a tough market.
It really is. And what's fascinating, especially thinking about the market's reaction, is that while Clover's reported payment volume growth in Q2 was 8%, if you strip out something called a gateway conversion, basically moving a merchant fully onto Clover from maybe an older Fiserv service or a third party, that underlying volume growth number is actually 11%.
Ah, okay. So 11% is maybe a cleaner look at organic growth.
Exactly. It suggests Clover is still successfully taking market share, even with all the competition. And the whole merchant solution segment posted a pretty solid 9% organic revenue growth in Q2. Clover's clearly the engine there.
So Clover is the powerhouse for SMBs. But Fiserv also deals with massive companies and merchant solutions. How do they handle those big enterprise clients? Their needs must be totally different.
Right, for the larger corporations, Fiserv offers Carrot. Carrot is designed as this really robust, integrated omnichannel operating system. It provides a whole suite of services, much more than just basic payment acceptance. Think sophisticated payment optimization tools, maximizing approval rates, minimizing costs, strong fraud mitigation systems, which are crucial for big volumes, and efficient digital payouts for refunds, disbursements, that sort of thing. Carrot is specifically built to enable those complex, modern consumer experiences we expect now, like buy online, pick up in store, or order ahead apps that blend digital and physical seamlessly. Beyond Carrot, they also handle complex gift card and loyalty programs for big brands through their store value solutions, and electronic billing services via biller solutions. Think utilities, insurance companies, governments needing to process tons of recurring payments.
Okay, that paints a really clear picture of merchant solutions, definitely a major growth engine, but that's only half the story. Well, let's switch gears to the other big segment, financial solutions. This side empowers the banks, the credit unions, the institutions themselves. How does this piece work? What's its role?
Right, so financial solutions is fundamentally about serving the banks and financial institutions, not the individual merchants directly. Fiserv provides these core platforms and integrated digital banking solutions. They help these institutions manage their operations, build customer relationships, and basically grow in this increasingly digital world. A huge revenue source here is their core account processing. This is the absolute bedrock technology. It lets banks manage customer deposit accounts, loan accounts, all that critical financial data. It's like the digital nervous system for a bank.
That makes total sense. So, for instance, when you see regional banks or community banks offering peer-to-peer payments like Zelle in their app, Fiserv is often the one providing the tech behind the scenes, right? The turnkey implementation.
Very often, yes. They make it easy for those banks to offer cutting-edge services without building it all themselves.
And we saw Zelle transactions through their platform grew 19% in Q2 2025. Shows
Yeah.
how vital these underlying services are. They also handle card issuance, credit card processing, even the physical making and mailing of cards.
Yep, the whole life cycle.
Yeah.
Card issuance, processing, manufacturing, mailing. It's comprehensive.
Mm.
And this brings up an important point about Fiserv's overall business balance. Financial Solutions is definitely a cash cow. Really high operating margins, over 40%, but its revenue growth is slower than Merchant Solutions, around 7% organically in Q2 2025.
So profitable, stable, very sticky, but not the high flyer growth segment.
Exactly. It's incredibly stable because switching core systems is a nightmare for banks, so it's very sticky. They also own and operate big payment networks like Star and MoneyPass, earning transaction fees there too, another layer of predictable revenue. So the takeaway is maybe not the fastest growth, but it throws off enormous high-margin, consistent cash flow that underpins everything else.
Okay, let's get into the very latest data now. The Q2 2025 results reported July 23rd. Because this is where the market reaction gets really interesting and maybe confusing for some. Given the stock's recent performance, there's a lot to unpack here.
Absolutely. So the headline numbers first. GAAP revenue up a solid 8% to $5.52 billion in Q2. GAAP EPS, earnings per share, saw a nice jump too, up 22% to $1.86. And then on an adjusted basis, which strips out some one-off items and often gives a clear operational picture, adjusted revenue was also up 8% to $5.2 billion. And adjusted EPS grew a very respectable 16% to $2.47. Overall, organic revenue growth for the quarter landed at 8%, which, in many industries would be seen as pretty strong.
Those numbers sound pretty solid, actually. Healthy growth. What about margins? Any red flags there explaining the stock drop?
Not really, no. In fact, the opposite. Adjusted operating margin actually expanded by a healthy 120 basis points. It reached a really robust 39.6% in Q2. That's a significant improvement.
Wow, almost 40%. That shows good efficiency.
Yeah, it points to strong operational discipline, extracting more profit as they scale. And free cash flow was strong too, $1.2 billion for the quarter. Plus, they kept their full-year guidance for free cash flow steady at around $5.5 billion. So continued strong cash generation. On the surface, financially and operationally, it looked quite healthy.
So here's the million-dollar question, or maybe the billion-dollar question, given that market cap. If the numbers seem pretty strong revenue, solid EPS, expanding margins, good cash flow, why the heck did the market react so negatively? This is the puzzle.
I think the key might be less in the absolute numbers reported and more in the guidance refinements for the rest of the year. While they did nudge their adjusted EPS outlook slightly higher at the low end, now $10.15 to $10.30, which is still 15-17% growth.
Like, sounds good.
Right, sounds good. But their full-year organic revenue growth outlook was lowered. It was previously guided at 10-12%. Now it's approximately 10%.
Okay, approximately 10%. That feels like a small tweak.
It is a small tweak, but it signaled a slight slowdown compared to what they expected before, particularly hitting Merchant Solutions, now aiming for the low end of its 12-15% range, and Financial Solutions too low end of its 6-8% range. For a company like Fiserv, with that history of consistent delivery, even a small recalibration like this can trigger an outsized negative reaction. It maybe suggests expectations were a bit too high, or the market just punishes any deviation from a perfect story.
And what reasons did management give for tweaking that outlook down slightly?
They gave two main reasons. First, they said there was a lower contribution coming from new initiatives. Basically, the ramp-up of new products and services they expected in the second half is happening slower than planned. So less revenue boost there.
Okay, slower ramp on new stuff.
Yeah.
What else?
Second, they mentioned a slightly less favorable economic outlook compared to what they'd factored in before. Although it's worth noting, some analysts found that second reason a bit questionable.
Questionable how?
Well, the argument was that the economic picture now, while maybe not great, is arguably clearer, or at least no worse than it was earlier in the year when the original guidance was set. So that discrepancy, that explanation, might have fueled some skepticism in the market. Like, is that the real reason?
Interesting. Okay, beyond the numbers, any big strategic moves or business developments in Q2 that caught your eye?
Yeah, definitely a few notable things happening on the strategic front. Capital allocation and expansion. They bought back a lot of stock. 12.2 million shares for $2.2 billion just in Q2. That brings their total buybacks over the last 12 months to $6.9 billion. Huge return of capital.
$6.9 billion in buybacks.
Wow.
Yeah.
Big commitment. So, as we'll probably discuss, that level of buyback versus debt is a point of debate. They also manage their debt profile, issuing about $2.2 billion in senior notes at a pretty good rate, 3.43%. Shows they still have good access to capital markets.
Okay, lots of capital moving around. What about actual business expansion, new deals, new markets?
Definitely continuing their acquisition strategy. That's always been part of their playbook. They agreed to buy the rest of AIB Merchant Services in Ireland. They already owned about half. That deal significantly boosts their opportunities in Ireland and gives them a stronger foothold in Europe generally. Plus, they announced a big agreement with TD Bank in Canada. They'll become TD's merchant processing provider there and acquire part of TD's existing merchant business. So really solidifying their North American presence and deepening ties with major banks.
That TD deal sounds significant. Now, this raises an important question, especially thinking about the future of finance. What's Fiserv doing about emerging tech, like stablecoins, digital assets? Are they playing in that space?
Actually, yeah, and what's fascinating here is they made a really notable move. In June 2025, they launched a new digital asset platform. And get this, it includes their own new stablecoin called SIUSD.
Their own stablecoin, FIUSD.
Yep, FIUSD. And it's not a solo effort. They're partnering with huge names: MasterCard, PayPal, Circle, Paxos, big players from both traditional finance and crypto. The whole idea behind FIUSD and the platform is to let banks and merchants access digital assets securely and scalably, enabling compliant real-time payments and settlements using stablecoins. So it really shows they're not just sitting on legacy systems. They're actively building infrastructure for, the potential future of money. It's quite strategic.
That's a very interesting development. And just quickly, for those tracking industry recognition, they're still getting awards, right?
They are. Named to CNBC's World's Top FinTech Companies list for 2025, that's the third year running, and also made it onto the Time 100 Most Influential Companies list for 2025, so still seen as a leader by many industry watchers.
Okay. So we've looked at the recent numbers. Q2 looked pretty strong in many ways, yet the stock reaction after both Q1 and Q2 was sharply negative. This is the core paradox we need to solve. Let's really try to unpack the why the market concerns. Let's trace it back to Q1 and see how things evolved.
Right, you're hitting the nail on the head. It often comes down to expectations versus reality. Go back to April. After Q1 results, stock drops over 18%. Now, revenue only modestly missed expectations. EPS actually beat them, and guidance wasn't even changed then.
So why the huge drop back then?
Investors were really surprised, maybe even spooked, by a notable slowdown in Clover's payment volume growth. It fell from 14% the previous quarter down to just 8% in Q1. That immediately raised a red flag for analysts who'd gotten used to Clover's stellar, often high teens, growth. Any deviation gets scrutinized, especially in a key growth engine.
Okay, but the company did offer explanations for that Q1 slowdown, right? Leap year, Easter timing, weakness in Canadian travel.
They did offer those explanations, yes.
But the market wasn't buying it. Or what was the deeper concern? Was it just a blip or something more structural about Clover?
I think the underlying worry was whether Clover's really impressive market share gains, which have been the growth story for Fiserv, were starting to slow down. Or, even worse, maybe starting to reverse. And that concern gets amplified when you look at competitors like Toast, which is killing it in the restaurant space with specialized software, or Block Square, still super dominant in small business POS. So the question became, is Fiserv losing momentum in its most exciting, highest growth segment? That perception of slowing momentum, even if slight, can just crush investor confidence, especially for a stock valued as a growth compounder. And then there was another factor that really started weighing on sentiment, especially after Q1. It was initially highlighted by one quite influential analyst who actually sold their Fiserv position, and that was the departure of their longtime CEO, Frank Bisignano.
Ah, the CEO change. He left pretty abruptly, right? To run the Social Security Administration.
Exactly, and for some, that created immediate uncertainty.
Now, this is something I think listeners grapple with. Does a CEO change really matter that much for a huge established company like Fiserv? It feels like such a big machine.
Well, for this particular analyst who sold, Bisignano's departure was termed a big pause. See, Bisignano had this really strong reputation as a proven operator, someone who, in the analyst's words, didn't mess with the numbers.
Okay, a steady hand, known quantity.
Exactly. Reliable execution. And the concern floating around is this double-edged sword of Fiserv's incredible streak, nearly 40 years of double-digit adjusted EPS growth.
40 years, wow.
Incredible, right? But the worry is new management, Mike Lyons is the new CEO, might feel immense pressure to keep that streak alive. And could that pressure lead them to, I don't know, change the approach, manage earnings differently, alter capital allocation, things the market isn't comfortable with yet? It absolutely creates what they call a show-me story for the new CEO.
Yeah.
Investors are basically saying, prove you can keep this train running without Frank.
So it sounds like there's this growing feeling in the market, maybe unfairly, maybe not, that Fiserv's status as the best-of-breed legacy payments company is long gone, or at least under threat. What really fuels that perception, even with the decent Q2 numbers we talked about? Is it just that slight guidance change?
It's a mix of things. Despite the solid Q2 headlines, that perceived organic growth rate has been a nagging issue. Remember the 7% reported in Q1? Some analysts dug in and felt the real number, apples to apples, was maybe closer to 5%. And that just looked weak compared to their own 10-12% guidance for the year. It created a credibility gap with Wall Street.
Right, that Q1 number set a negative tone.
It did. So even though Q2 guidance was refined down to approximately 10%, acknowledging the slower initiative ramp and maybe the economy, the damage from Q1 lingered. And there are now these genuine, deep-seated concerns that maybe, just maybe, they won't hit double-digit adjusted EPS growth this year, breaking that incredible, nearly 4-decade streak. That would be huge, symbolically and maybe fundamentally. That history created sky-high expectations. Any deviation, or even the hint of one, gets punished severely. It shifts the narrative.
Yeah, it really highlights how even small misses or minor guidance tweaks can have these massive ripple effects when a company has built such a reputation for consistent outperformance. The bar is just incredibly high. Okay, let's shift focus slightly and drill down into the hard numbers of Fiserv's financial health, looking beyond just the quarterly noise. We've seen the stock price swings. Is it genuinely undervalued now after these drops? A bargain? Or is there some underlying financial weakness the market is correctly seeing?
Well, connecting it back to the big picture, Fiserv has always been a cash cow, a free cash flow machine. They generated $5.3 billion in free cash flow over the 12 months ending Q2 2025. That's a lot of cash.
$5.3 billion, okay.
And that strong cash generation makes its current valuation around 18 times its 2025 free cash flow guidance seem reasonable to some analysts, especially when you compare it to its historical median price FCF multiple, which has been around 20 over the last couple of decades.
So cheaper than its history suggests it should be.
Potentially, yeah. In fact, some more bullish analysts look at the current price FCF around 15, maybe a forward PFCF around 12.5, and they see that as very low, a potential great opportunity. It suggests a real disconnect between how much cash the business pumps out and how the market is valuing it right now.
Yeah.
Could be a bargain.
There's always a but, isn't there? You mentioned debt concerns earlier. That's a point of friction for some investors. Give us the full picture on the balance sheet. How significant is that debt?
Yeah, this is definitely a key point of debate. Fiserv carries a significant debt load, no question. Total debt is nearly $30 billion.
Yeah.
And they only hold about $1 billion in cash. So net debt is substantial.
$30 billion, wow.
Right. That puts their net debt to EBITDA ratio around 3.36, and their total debt to equity is 115%. Now, for a company this size in this industry, net debt to EBITDA over 3.0 starts to feel a bit high for some. It potentially limits flexibility, increases sensitivity to interest rates, and 115% debt to equity. That's quite leverage compared to, say, a software company funded more by equity. Now, their interest coverage ratio is good, 9.80. They can easily cover interest payments right now. But for some analysts, just the sheer level of debt is a notable weakness, especially when rates aren't rock bottom anymore.
So how are they managing this debt, especially since a lot came from a big acquisition, right? Is there a clear plan?
Yeah, a huge chunk of it, around $17 billion, traces back to that massive $22 billion all-stock acquisition of First Data back in 2019. And that deal also meant taking on First Data's old debt from its 2007 leveraged buyout. So it's partly a legacy issue.
Okay, so it's been around a while. What's the plan?
Fire's stated strategy is basically twofold. First, refinance the debt, push out maturities, lower interest costs. They've been pretty successful at that. Second, use their strong free cash flow to gradually pay it down over time. However, this is where the debate really heats up. Remember those huge share buybacks?
Yeah, $2.2 billion in Q2, nearly $7 billion over the year.
Exactly. That high rate of share repurchases, they even upped guidance to repurchase about 130% of free cash flow, is a major point of contention.
So the argument is, shouldn't they prioritize paying down that $30 billion debt instead of buying back so much stock, even if buybacks boost EPS?
Precisely. Buybacks are shareholder-friendly, they boost adjusted EPS, and Fiserv has cut its share count by 18% in 5 years, which is significant support for the stock price. But there's a real debate about whether spending so much on buybacks is the optimal capital allocation choice when debt levels are this high. It's that classic tension, short-term EPS boost versus long-term balance sheet strength and de-risking. Just purely on debt paydown using all their current free cash flow, it might take them about 6 years to pay it all off.
6 years. Okay.
Which isn't terrible, but it's not ideal either for investors who prefer less leverage, especially given economic uncertainties. This whole capital allocation strategy is really central to how people view the stock right now.
Got it. Beyond debt and buybacks, what about profitability and, crucially, returns on capital? Are their investments actually creating value?
Well, operating margins are definitely trending up. Strong operational capability there. Adjusted operating margin hit that impressive 39.6% in Q2. That's good execution. However, here's another critical financial point. Their return on capital employed, or OCE, and return on invested capital, ROIC, they remain under 15%.
Under 15%. Is that good or bad?
Well, maybe more importantly, they're currently lower than their weighted average cost of capital, or WACC, and that's generally seen as problematic by analysts.
Why problematic?
Because it basically indicates that the capital they've deployed recently, whether through big acquisitions like First Data or internal projects, might not be generating returns high enough to cover the cost of that capital. In simple terms, while they're profitable overall, their efficiency in deploying new capital might need improvement to truly create economic value for shareholders. It's not just an accounting thing. It's fundamental to whether growth is actually adding value relative to its cost.
Okay, that's a really important nuance. Let's shift gears again and look outwards. Who is Fiserv actually competing against in this crazy, fast-moving payments world? How do they stack up?
Oh, it's intensely competitive. You've got a whole spectrum of players. Established giants, nimble fintechs, everyone wants a piece of the payments pie. But Fiserv is a market leader, or very close to it in most areas they operate in. That speaks to their scale and history. Take merchant acquiring, for example. They were the second biggest acquirer of card payments from U.S. merchants in 2024, processed almost 41 billion transactions.
Second biggest. Who's number one?
Well, notably, they were recently overtaken by JP Morgan as the number one player there, which just highlights how fierce the battle for share is, even at the very top.
Okay, so who are the main rivals specifically in that merchant space, where they have Clover and Carrot? Who keeps them up at night?
In a merchant space, it's a real mix. You've got big, diverse players. Block, with Square, obviously huge in small business POS, very strong brand, easy-to-use system. Adyen, a European powerhouse, but a serious global competitor, especially strong with larger international e-commerce firms. Very tech-focused. PayPal, dominant online, strong digital wallet. Stripe, super popular with startups, tech companies, great APIs for developers, especially online. Then on the enterprise side, Chase Payment Solutions is a major force, leveraging that huge banking network. And Global Payments, another big player, quite similar to Fiserv in structure, actually. Plus, you have these niche players like Toast really carving out territory, especially in restaurants with tailored software.
So Fiserv's advantage is maybe its breadth, covering everything.
Breadth, scale, that integrated ecosystem of hardware, software, payments, and those long-standing relationships, definitely.
And what about the financial solutions side? Banking tech, core processing. Who are the main competitors there?
In financial solutions, Fiserv holds a really commanding position. Market share estimates are around 35–38% for banking tech. And this market is defined by incredibly high switching costs. It is a massive disruptive project for a bank to change its core system.
So once you're in, you tend to stay in.
Pretty much. Key competitors here include FIS Fidelity National Information Services. Very similar, diversified model. Jack Henry & Associates really strong, especially with regional banks and credit unions, known for good customer service. Internationally, Temenos is big, mainly in Europe, and Oracle Financials focuses more on the very largest global banks. So it's competitive, yes, but also incredibly sticky. Fiserv's deep integration and long history are huge advantages there.
So given all that intense competition, what kind of moat does Fiserv actually have? What protects its business, makes it hard for customers to leave or new players to really challenge them?
It's a great question. Morningstar, which analyses moats, classifies Fiserv as having a narrow moat with a stable trend. They say, look, parts of the business like core processing or maybe Clover's integrated system have elements of a wide moat, very hard to displace. But other areas face more intense competition, maybe have little or no moat. So overall, it averages out to narrow.
Okay, narrow moat. What are the main pillars of that moat?
Primarily, high switching costs. We just talked about this. It is hugely difficult, costly, disruptive for clients. especially banks or merchants deep into Clover's ecosystem, to switch. That creates sticky, recurring revenue, probably their strongest moat source. Second, intangible assets. Think proprietary tech platforms like Clover and Carrot. That's valuable IP. Plus, their huge distribution network built over decades and those long-standing relationships with banks and merchants. Hard to replicate quickly. Third, network effects. Morningstar calls these medium strength. The idea is the more merchants and banks use Fiserv platforms, the more valuable the whole network becomes for everyone through data, integrations, shared services, and finally scale. Their sheer size lets them spread fixed costs over massive transaction volumes. That should create a cost advantage over smaller rivals. Though some argue that cost advantage isn't universal across all segments, especially where specialized niche players operate, which is why it's maybe narrow, not wide.
Got it. Okay, looking ahead now, what are the biggest opportunities for Fiserv to keep growing, especially in this fast-changing payments world? Where's the upside?
Well, the biggest tailwind is just the ongoing global shift. More digital payments, more e-commerce, more demand for real-time payments everywhere. That rising tide lifts their core business. Beyond that, a huge opportunity lies in international expansion. They're still heavily U.S.-focused. Expanding Clover globally into markets where SMBs are just starting to digitize, that's a big runway. And those recent acquisitions in Canada and Ireland point directly to that focus on untapped international potential. Could be substantial new growth.
And what about getting more from the clients they already have? Is there potential there?
Oh, absolutely. That's a massive lever for them. Increasing the penetration of value-added services, VAS, to their huge existing base of merchants and banks. Think about Clover, those VAS features like analytics, CRM tools, loyalty programs, and even lending. That's currently less than a quarter of Clover's revenue. Huge room to grow by cross-selling more stuff.
Right. Sell more services to the customers they already have.
Exactly. They also see thousands of potential partnerships with independent software vendors, ISVs, integrating payments into specialized software for different industries, then cross-selling. And of course, their proven strategy of strategic acquisitions, buying technology, entering new markets, gaining scale. That's always been a key driver and likely will continue to be.
Makes sense. But every opportunity comes with challenges. What are the key threats or headwinds Fiserv needs to navigate carefully?
Well, number one is just that intense, evolving competition. For the big processors, from banks' own in-house systems, and especially from those disruptive fintechs who could be faster, more specialized, it's a constant battle. Cybersecurity risk is absolutely massive. They process unbelievable volumes of sensitive data. A major breach would be catastrophic for reputation, fines, client trust. It's an ever-present operational risk. And they operate in a really complex regulatory landscape. Things like GDPR in Europe, data privacy rules, financial regulations. It's constantly changing, requires huge investment in compliance, and can limit what they do.
And the bigger picture, the economy itself, how vulnerable are they?
They're definitely exposed to macroeconomic headwinds. An economic downturn means less consumer spending, less business activity.
Which means fewer transactions for them to process.
Exactly. Lower transaction volumes hit their revenue directly. Rising interest rates also hurt because their debt load makes servicing that debt more expensive. Inflation can dampen spending too. Political instability isn't helpful either. And the sheer pace of technological change is a constant threat. They have to keep investing heavily in things like AI, machine learning, maybe blockchain, just to keep up. If they fall behind, competitors could leapfrog them. Which again brings us back to that crucial capital allocation question, build or buy innovation, all while managing the debt. It's a tricky balancing act.
Okay, so wrapping this all up, what does this mean for you, the listener, trying to make sense of Fiserv's journey? We've painted a picture of a company with this really remarkable history of performance, consistent growth, fueled by smart acquisitions, incredible cash flow generation. Yet, lately, the market has just hammered the stock, driven by worries about the CEO change, subtle shifts in growth expectations for key areas like Clover, and that persistent nagging issue of high debt. It really feels like a long-term winner facing this intense period of scrutiny, a real prove-it moment.
Yeah, connecting it all, Fiserv is just this fascinating case study, a mature, absolutely critical infrastructure player trying to navigate this super competitive, fast-changing tech landscape. The fundamental question really boils down to this. Can their proven operational skill, their ability to integrate acquisitions, plus those huge share buybacks, can that outweigh the challenges? Challenges like shifting market share dynamics, the pressure from competitors, and the burden of that debt in potentially tougher economic times. The market is clearly saying, show me you can keep delivering under new leadership and amidst these pressures.
Ultimately, the Fiserv story seems to be about balancing that foundational stability, they are essential, plumbing for the financial system, with the urgent need for transformation and innovation in this digital payments era. So, is the current valuation, which is way off its historical highs, a deeply discounted opportunity, a chance to jump back on a potential compounding train? Or do these recent headwinds, the debt, the competition, signal a genuinely tougher road ahead, where maybe that amazing past performance isn't the best guide to the future?
And this really brings up an important question for you, listening and thinking about this as an investor. In today's world, with tech changing so fast and competition so fierce, how much weight do you give a company's historical consistency and its leadership in core markets versus the absolute imperative for hypergrowth, innovation, and maybe a cleaner, less leveraged balance sheet? It's that fundamental trade-off investors constantly face with established giants in dynamic industries. How do you weigh those factors?
Definitely something profound to ponder as you continue your own deep dives.